What should your whole life insurance policy look like if your goal is maximum cash value? That is the name of the game, isn't it? So when it comes to a whole life insurance policy and really setting it up for maximum cash value, the design is one of the most important things. Now, before I just dive into policy design, which it is one of my favorite things to talk about, and we are going to look at, in the next video, live policy design. That'll be a lot of fun if you like to see the inner workings of how these products are designed. But let me just ask this first, because here's a question a lot of people ask when it comes to whole life insurance policies, is why would I do this? Have you ever been presented a whole life insurance policy, or maybe you've purchased a whole life insurance policy before and you looked at the numbers and just scratched your head and thought, why do I keep paying money into here? Because my goal was cash value. So not assuming that you got it for the death benefit, at least that was not your primary objective, but the cash value, that was your goal. You're looking at it and thinking again, like, why did I do this? It's taking forever just to get my money back. This comes up quite a bit. I remember almost 2 years ago, not quite, but just about 2 years ago, I was working with someone, young guy. He does over 9 figures per year as far as annual revenue for his business. But he was presented a whole life insurance product before him and I had ever connected. And when he was presented that policy, that's the reason why we actually eventually got to connect, because he did not move forward with the policy he was proposed. The question he asked when he was shown that option, he let me know this, was, why would I do this? Why would I pay all of this money into a whole life insurance policy and I don't see any real value, or call it gain, on my cash value for like 10 years? Like, it just doesn't make sense, not with the way that I want to use my policy. And he was a business owner. He viewed the opportunity cost as something very, very important to look at, or he viewed it as something very, very important. He wanted access to that cash value. He doesn't even need it. He hasn't used the policy he set up, but he likes to see it there in the event he wants to use it for anything. And everybody's different as far as what their goals are. So what's your goal? And is the policy set up properly? If it's maximum cash value, is it set up for maximum cash value from start to finish? So then you can use that cash value for opportunities that you have. So a lot of times what people go with begrudgingly, or they find out after the fact it could have been set up different, is a policy where long term, I have it looks great, it looks decent, but boy does it hurt up front. Example, basic whole life insurance policy. Let's assume that you take out an old school, traditional whole life insurance policy, a great example of what not to do. How it works is like this. You pay a premium, you have life insurance, and eventually you see the cash value build up. Let's use a $10,000 example. We've got $10,000 per year going into this whole life insurance illustration. This is a traditional old school life insurance policy, and this is just buying a life insurance policy. No fancy riders, just a $10,000 premium. That's how much the individual is paying per year. And what do you notice here? First, you might look at this and think, look at these stereo instructions. There's like a million columns here. Well, annual net outlay or annual outlay, these two are the same. If this is you, this is a 35-year-old individual, at the end of the first year is 36, but if this is you, this assumes you're going to pay $10,000 per year for a life insurance policy. Here's the death benefit, the money that is paid out to your beneficiaries, income tax-free if you die. So if I pay in 10 grand and my beneficiaries get 764,000 the next day or in the first year, okay, that's a good deal. Not compared to term though, if I'm purely focused on the death benefit. If you're focused on the cash value, 10,000 goes in. There's your cash value in the first year. This is your money column. Total cash value end year. Some illustrations, depending on what company you're looking at, that will read net cash value. I want the total or net cash value. That's your money column, money you have access to. First year, zero, literally a zero. Second year, you pay $10,000 in. What do you notice here? Just about $900 is in cash value that you can access if you'd like. You've paid in $20,000. By year 3, I start to see more of my premium come back. I'm $7,200 and change, but it takes a long time. In fact, look at this. When do you actually get your money back? By year 10, you've paid in how much? 10,000 times 10 is what? $100,000. How much do you have? $78,000. You want to wait that long to not get your money back in this case? It's still a $22,000 loss. That's a lot. And that's not factoring in the lost opportunity cost, meaning what can you do with this $10,000 all of these years, the first 10 years? This is the kind of stuff people look at and the questions and points they often raise. And how I always view it is I don't want this to sound wrong, I don't really care what my peers and agents in the business are saying as far as here's how to sell the product or points to raise to kind of get people to see it in a specific way. What I'm most concerned about is what questions, points are being asked and raised by the person purchasing the policy, starting the policy, and those are what we want to address. If we flip positions, $10,000 for 15 years is $150,000, so you've paid in $150, and how much do you have? $154. What if you go back 1 year? You've paid in $140, and you've got $137. So this, again, is a great example of what not to do. We don't sell these types of policies. I would not recommend it if your goal is maximum cash value, that is, or just a high cash value policy. You can do way better than this from a design standpoint when we look at the overall design. So how do you improve it? That's the question that often comes up. Let's assume that that's you. And if you're looking at 10K per year, if it's 100K per year, we can add a zero. You're going to see examples of all sorts of different dollar amounts. But if that's you, how do you improve that policy? Say it's the same product, same company, and the same $10,000 per year. How do you make it better? Because you easily can. So how can I improve the cash value? The agent must design, so it's the agent needs to design the policy for higher cash value. The out-of-pocket for you is exactly the same, and we can design it where it's very flexible, so you can bounce payments up and down. But if we're just keeping the same $10,000 per year, how do we keep that the same and get you more value, short-term and long-term? What happens here is we're choosing where the money's going. Did you know with a life insurance policy, you can actually decide where your money goes? You can decide if it goes toward the insurance premium, which the example we just saw, every penny of that $10,000 went toward the premium. Or you can decide to put less toward the premium. We'll show you exactly what the minimums are as well, and more toward riders. You'll see the terminology PUA stands for paid up additions rider. I can put money toward riders instead, which guess what? Give me cash value immediately. That's money I can access immediately. That's money that inflates the overall, or I should say, accelerates the overall cash value growth on a guaranteed and non-guaranteed basis. A nice feature to really give me more money. When I say give me more money, the consumer, you the policyholder. And here's why I emphasize that point. So if you were to go ask for a quote from a life insurance agent and you get a basic whole life insurance policy, and then you ask, hey, can you improve this policy? I'd like to keep my cash flow the same amount of money going in, but I'd like to see more cash value up front. Can you make this look better? You might be shown some options. You also might get some pushback. And the reason why you might get some pushback here is, generally speaking, the higher the cash value is upfront, I should rephrase, the higher the upfront cash value is, the lower the agent commission is. Simple as that. So when we look at policy design here, so going back to where I mentioned, you can choose where your money goes, toward the insurance premium or toward riders. So here's the big thing here. So let's assume you're going to pay in $10,000 per year. Let's make this a little bit skinnier. There we go. So of that $10,000 per year, you can pay it all toward premium, and it will look exactly like that illustration we just looked at, meaning zero in the first year and next to nothing in the second year. If we looked at the guarantees, it would be zero in the second year. But dollars that go here, what if we can do this? So of the $10,000, let's put $1,000 toward the insurance premium piece, premium dollars, do not show up in cash value if we look at that same policy we did, that traditional product, in the first year and also the second year of the policy. Now, as you continue to make payments to that policy, if you continue to fund your premium beyond just 2 years, you can fund it for only 2 years. We can show you some examples of that. But the third year, you'll start to see that premium come back, just like we saw in that illustration, gets better and better each year. Premium dollars do buy you a death benefit. It's the insurance premium that is purchasing you the whole life insurance policy, the death benefit there. But many people, I remember when I first started learning about this, I'm playing around on my computer with the illustration software, and my dad asks, can I just put nothing into the premium and everything into the PUA rider? Like, you can't quite go that aggressive. The reason why is there's limits. Before I just jump into those limits, let me explain the PUA rider here. So of that 10,000, you put 1,000 toward the PUA rider, 1,000 toward the base premium, and then 9,000 toward the PUA rider. That shows up in cash value. That's money you can access. Improves the guaranteed values, and also begins to earn dividends. Adding money to this PUA, which again stands for paid up additions, I like to refer to it as a cash dump in for simplicity. That's really the key to accelerating the cash value growth on a life insurance policy. Now, it will buy you some death benefit. It does depend on our age, gender, the product. On average, if you're that same 35-year-old male, if you paid $1,000 in, you'd see about $3,000 show up an additional death benefit. But why people will just plow money into the PUA rider is really for the cash value benefit. Now, the reason we cannot put 0 in the premium and 100% in the PUA rider is because we have limits to be aware of. And they are as follows. You've got the insurance company limits and then also the IRS limits. So when we look at the insurance company limits, that has to do with whatever our total payment is, how much can be directed toward the premium, and how much can be directed toward the PUA rider. Typically, with some of your major mutual companies like a Mass Mutual, Guardian, New York Life, and Northwestern Mutual, the lowest you can set that premium is about 10%. In some cases, you can go lower. I would check out our PUA rider video, which goes through the PUA limits with 5 different companies, 3 of the major mutuals and 2 smaller companies, and that gives very, very specific details as to what you can and cannot do with different life insurance carriers based on their company limits, contract language, all of that fun stuff. But if I've got a 10% minimum, which a lot of times is the case, very close to that with the major mutuals, that means if I want to pay in $10,000 per year, the lowest one can set that base premium, or that I could set that base premium, would be $1,000 per year. If I said, well, I want the ability to pay up to $100,000 per year into this life insurance policy, Safe Liquid tax-free, then I would need a base premium of $10,000 per year. Here's a cool part. Depending on the company and flexibility features, I can easily commit to that $1,000. And then at my discretion, I can just throw more money into PUAs. So you can design it to be extremely flexible if you'd like, which is a lot of fun. A lot of people we work with say, okay, my cash flow is all over the place. Let me commit to a minimum amount and I'll throw more money in at my discretion. So first limit, insurance company limits. The second limit we mentioned is an IRS limit, which we always want to be aware of IRS limits, don't we? So when we look at the IRS, what's the third core benefit to a cash value life insurance policy? Tax-free. Tax-free if we do things properly. So any life insurance policy can become classified as a MEC, a modified endowment contract, if it does. What happens is your cash value still grows tax deferred, but anything you access with respect to the gains, you've got to pay ordinary income tax And if you're touching it before the age of 59 and a half, there's a 10% penalty tax. We don't want this to occur, this modified endowment contract. Now there's more information on this. I would check out our MEC video where we go through that in full detail if you'd really like to understand that. But if you just want the highlights, we do not want our life insurance policy to become classified as a MEC if we want to have access to the cash value. If a policy is a MEC, the death benefit is still paid out 100% income tax free. So some people will deliberately take out MEC policies really just to make a one-time lump sum payment, pay money income tax free once they die to their beneficiaries. There is a strategy there that's suitable for some people. Similar to what banks do, because banks don't access the cash value with the BOLI policies. Those are universal life, single premium MECs. But here, how do I prevent this? Because I don't want it to occur. Well, every policy has what is called a MEC limit. Here's the fun part. You can set that MEC limit wherever you want. How you do it, well, the agent needs to do it, but you can work with them on this. How you do it is you'll find that it has a direct relationship to an individual's age and total amount of life insurance on a policy. There's some other factors, such as the guaranteed rate with a product, gender, things that agents need to be aware of, not so much you. The nice thing is you'll see always disclosed with most companies, not all of them, you'll see exactly what that MEC limit is. So, being that the MEC limit has a direct relationship to what? Our age, but what's the other factor? Death benefit, total amount of life insurance. Why is that important? Well, the death benefit comes with a cost. So how do I put my costs at the absolute minimum and plow more money into PUAs to maximize cash value? So what you'll find, and we'll really go through this in detail in the policy design video that typically paints a lot of, or provides a lot of clarity for individuals. But if I just have a policy with a base premium of $1,000 and I throw $9,000 into PUAs, I'll usually trigger a MEC. Now with that, how you prevent it, so keep the premium at $9,000. I might add $300 to term insurance, which would actually reduce my PUA payment to $8,700. But what this does is buy me a lot of life insurance for a very, very low dollar amount. And this is my not so straight lines. That raises my MEC limit, is what that does. Cost-effective way to raise the MEC limit, the term rider utilization that is. So it's a very nice option to be aware of. But in summary here, how we will maximize the cash value and flexibility for that matter when we look at the policy design is we'll really drive that premium as low as we can based on the insurance company's limitations. How do I shrink the base premium and then add a term rider to raise the MEC limit and then plow everything else into PUAs, or have the ability to do so. Why I keep saying that the ability is a lot of people over the years have expressed, hey, I really like the idea of throwing a ton of money into this policy, but I don't want to get a bill for it. There's a couple that ran not a dental practice, endodontists that we had worked with, that we still work with, and they wanted to be able to pay in $300,000 per year to a policy, but they did not want to be billed for $300,000 per year. So how they set it up is they're billed for just about $30,000, a little bit more with the term rider, and then at their discretion, they'll add more funds up to a total of $300,000, just when we look at the design. But hope this one helped. We'll see you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.